Hey there, welcome back. And in this segment, we're going to look at the assets section of your balance sheet. And as I mentioned in the intro, your assets are anything that is owned by the business. That even if you have a loan on something, you're still going to want to show it in your assets. And so let's talk about some of these areas within your balance sheet. And so on my screen, you can see that we're using the Quality Built Construction, which is the company that we've been working on. This is a sample of a construction company. And this particular company's current assets are as follows. So you can see that they have different checking accounts. So they've got a main checking, they have a savings, they've got a checking for their payroll, and then they've got petty cash. And although petty cash isn't held into a bank, it's still cash, so it's still held within as a checking account type of asset account. So then you've come down here and you've got, your total for all of your accounts together. So followed by, and by the way, your most liquid assets are held on the top. So all of your checking, your cash accounts. So even if you had a money market account or say a CD, you're going to see these and keep them up towards the top because they are related to your cash. Okay. So next in line would be receivables, and your accounts receivable are those monies that are due you from customers. And hopefully the way that you're doing things is you don't have a whole lot of receivables, but you're being paid up front and not carrying people too far into the future. The longer it takes for someone to pay you, the least likely it is that you're going to get paid. So if you are carrying accounts receivable, make sure that you have a system in place that is religiously pulling an aging report. And by an aging report, that is the listing in detail of every invoice that is currently due to you. And have your bookkeeper go through and make phone calls, religious phone calls. Have them develop relationships with those at the other businesses or homeowners that you're contacting, the banks, whoever it is that you're going to call for your money. Have them develop relationships with them and get on the phone and just make those calls. You know what they say about, the squeaky wheel gets the grease. Same instance in this. You always want to be front of mind when somebody's paying their bills, so they're more apt to send you a check. Again, get as much as you can on the site before you leave. Come up with different ways of payment to allow for the easiness of a customer paying you, which means you're more apt to get paid. So don't just say, yeah, just send me a check. Make sure that you give them an invoice. Make sure that you give them different forms of payment. You can even, give them a discount if they pay within 10 days, whatever that looks like for you. But this is where your receivables are kept. So any money that is owed to you is going to be held here. So one thing that you might also notice in here on your books or maybe someone else's books is there might be what they call a note receivable. And that could be something to, like, let's say that you loaned, ABC Construction $50,000 as a startup. They're going to pay you back. They just needed to borrow the money. You're not investing in them. You're just loaning them some cash. So this is where you would record that. So you would have a note receivable, say ABC Construction. And as that company pays you back, you'll reduce this dollar amount. So again, money will go in as cash and your receivable will be reduced down. But when you're doing things like that, you always want to make sure that you're recording it in your books, because that way you're less apt to forget about it and have it be a loss. So, and those are some of those hidden losses that, we don't see because as time goes by, we get busy and we forget about them. So always have them showing on your books so that you don't forget. That way they're least apt to be forgotten about, and you're more apt to get paid and recoup that money. Other current assets could be, in this case, is a security deposit. So current assets, those are really simple. I mean, I'm trying to think of something that I would keep in current assets. Maybe short-term bank notes or something. Most of the time I fixate on these fixed assets, and this is where you would keep your assets, your belongings, basically. So, furniture and fixtures, automobiles such as your work trucks, machinery if you have backhoes or, that type of thing. Those you will keep in here. Now, mind you that tools and stuff don't go in here. So if you want to have a threshold, and what I mean by that is every company has a policy or a threshold on what they consider to meet the requirements to be a fixed asset. And usually companies will go with either 1,000 or 3,000. In the case of smaller companies, a lot of times they'll go with 1,000 or the 3,000. Larger corporations sometimes go with 5. Usually it's around 3. But what you'll want to do is record those here, and then anything that is less than that threshold, you would record in what you would call a tools, small tools and supplies, and that is on your income statement. So that's an expense account. And what ends up happening here is anything that's a fixed asset is depreciated over time, and that's what this one right here is. It's called a contra account, and so it basically erodes these so that once these are all depreciated, your assets will be, your total fixed assets will be these totals minus your accumulated depreciation. And so the depreciation will eventually, basically zero this out. You still have them as assets, but it's showing that you've already taken all the depreciation on them. It doesn't mean that these are less valuable. It just means that you've depreciated them. So anything that is less than what your threshold is, again, don't put it in here. So like if you go out and buy 10 hammers, don't put those in here. You want those to go as an expense for, small tools, or not even hammers actually. Those you just put on, job supplies or something. Something that would go into small tools might be a saw, or what are those things called? That saw that's electric saw. I can't think of the name of it. Anyways, Sawzall. There you go. That could be something that you could put into small tools and equipment, but it wouldn't go under as a fixed asset. So one of the other things that has to qualify as a fixed asset is that it's not a consumable. It has to be something that is going to last for at least 1 year, if not longer. And so machinery, obviously, if you bought a backhoe, it's going to last longer than a year. It's going to be well over $3,000. Same with a car or a truck. Computer and office equipment. So computers, yes, you want to track those. Office equipment, they don't use fax machines anymore, but these could be those standalone printers, things of that nature that help you run the business from the admin side. Printers, computers, monitors, you don't really put there. Those would be listed and just, expensed out as you purchase them. They're not really worth much. You can get them now for like $100, so you don't really want to worry about that piece. So, again, so fixed assets, that's basically what your assets are. And you'll see how when we move into liabilities, how that might kind of play out a little bit. So you can see what I'm talking about when I say, well, you either, you have just because you have a loan on it doesn't mean it's not an asset, because you still have it in your possession. It just means you're making payments on it. So that is our assets section, and I'll see you for liabilities.